Okay, thank you very much, Rama, and to the other organizers to have me here to give the introductory talk. So, as most of you probably know, I'm like at the intersection between academia and policy making, and I designed this talk, this introductory talk to this workshop, also along those lines, entitling it "Systemic Risk, Macroprudential Supervision and Regulation," and it draws on both my 15 to 20 years of own experience in systemic risk research and macroprudential research, as well as on more recent research that we have done in the context of this ESCB, the European System of Central Bank Macroprudential Research Network. So this is the outline for my talk. I will talk briefly about the definition of systemic risk, give one example why macroprudential research may be important. There's many reasons why it's important, but I give one research example, own research, and then I will give a one-slide summary of what the MARS network, the Macroprudential Research Network, was. Then I give you a little economic framework, a mini economic framework on 2 slides that those of you who saw me in the last few years traveling around the world and explain systemic risk to people will know it. So, but I still thought that maybe there's some new people in the room that I should explain it to. Then I will, in the third part, going from the different forms of systemic risk that are derived in this little economic framework, go to analytical tools. Tools that basically draw on scientific methods and research, but for practical purposes. And you will see what that precisely means. In the fourth part, I will talk about macroprudential policies. Actually, the end of the third part on the systemic risk identification tools already makes a transition to the policy assessment side. So I will show you, I will go through the list of macroprudential policy tools, policy instruments, regulatory policy instruments that are usually discussed in this context, and give you also an example of a certain capital regulation in the context of a model that is particularly geared towards putting financial instability into macroeconomics. And then in the last part I will make some very brief concluding remarks trying to stimulate the discussion that follows. So let's go. Some definitions. So we in the ECB have thought many years ago about how to define systemic risk. How we define it is written up there. It's the risk that financial instability becomes so widespread in the financial system that it impairs growth and welfare in the economy at large. Okay. So if you lead, this is an extremely broad definition, but it's a definition that is actually relevant for central banks or for macroprudential policymakers. As a matter of fact, if you read the mandate, that the statutory, the legal basis of the European Systemic Risk Board, a body that was created like 4 or 5 years ago to help maintaining systemic instability in the European Union, then actually the definition they have for systemic risk is very, very close to this one. You will hear many people starting their talks when they present a new model to you saying, we have no agreed definition of systemic risk, so let me start here, okay? Now, but if you go through people who have thought about how a general definition could look at, actually, be it in the BIS, in the IMF, in some academic circles, many of the definitions that are kind of comprehensive, they read similar to this. I don't claim that this is the only possible one, as with any definition, but it is one that has the features that most people think need to be covered. Now, an implication of this very broad definition is that you have to look at all components of the financial system. So if you want to have an encompassing theory, okay? But in the end, if you talk about systemic risk, you want a full view of systemic risk, you have to consider all subsectors of the financial sector in order to identify when is the problem widespread, for example. So it incorporates the intermediaries, but not only the regulated, but also the unregulated, the financial markets and the market infrastructure, the payments and the settlement and the clearing systems. And this we call the horizontal view. The horizontal view is the view on systemic risk within the financial system. But very important in that definition and highly relevant for central banks, and my example will illustrate this in a second, is actually the two-way relationship with the economy at large, with the macroeconomy. That's what makes systemic financial crisis really problematic. The large downturns that follow, and therefore that you can call the vertical perspective, you're going from the horizontal to vertical perspective, is also taking in a model, for example, the two-way interaction between the impaired financial system, the widely impaired financial system, and the macroeconomy into account. I separate this, slice the problem in these ways because the literature over the last 10, 20 years has tended to think in those terms. Some theories are only horizontal, others particularly focus now on the vertical perspective to integrate with the macroeconomy and so on. Now then, what's macroprudential policy? That has two parts, the supervisory or oversight part and the regulatory part. The supervisory and oversight part is the public oversight that aims at identifying and containing systemic risks, rather than the risks of individual intermediaries or markets, which would be the microprudential supervision. The macroprudential regulation then in turn would be the public regulations that aim at maintaining systemic stability as defined above, overall, the overall macroprudential regulatory policy. So after this definition, just a quick jump into one of the research outputs as an example of the Macroprudential Research Network. This is, some of you may have seen that. It's the composite indicator of systemic stress. Actually, it was put the #1 indicator in the systemic risk dashboard of the European Systemic Risk Board. So it's now published regularly in the dashboard of the ESRB. And actually, it's now also quite frequently cited in the media or in the news wires what type of systemic instability level the KISS actually shows. So how does that work, this KISS? I asked about like a year or two after the breakout of the financial crisis, a young research analyst came to me and said, I want to work on financial stability indicators. And I said to him, great idea, beware of the problems with those empirical indicators, but be systematic. And try to be systemic. Distinguish yourself from the other indicators by having a systemic indicator. And beware to distinguish early warning, forward-looking, from contemporaneous. Differentiate, at the start at least, a thermometer from a barometer. The KISS is a thermometer. It measures the systemic instability at a given point in time. It is not intended to act as an early warning. As you can see, I will tell you in a minute how it works, but this is before 2007. It would be miserable as an early warning. But it's pretty good in measuring the degree of systemic instability at a given point in time, the overall instability that has broken out. How does it work? So be systematic and be systemic. So systematic is all markets and intermediaries should be covered in it. So this is why, contrary to other financial stability indices or indicators, it has not only the main financial markets in there, but also an important block of intermediaries, banks and other intermediaries. So it has 5 components, the 4 main markets and the intermediaries. And for each of these 5 components, it has 3 submeasures of stress, of financial stress. So these can be volatilities for equities, or it can be downward trends for equities or bonds. It can be spreads, credit spreads for bonds, for example. And for the intermediaries, for example, one of the sub-indicators is the recourse to the marginal lending facility of the ECB, which is the emergency liquidity assistance that the banks gets from us in a crisis, potentially. So these 5 components have each 3 sub-indicators measuring stress. Now, another key component, apart from being wide, systemic, this indicator is how it aggregates this information. So it has 2 particular features. One is it takes the dependence between the 5 components into account and thereby makes it a systemic indicator particularly. So that means it spikes out more towards upwards if there's more systemic instability, in the sense that actually these components are in stress together rather than independently of each other. And it spikes down by less if more independent stresses happen in these 5 components. And there's a third special feature which distinguishes this indicator, is that actually a component, one of these 5 components, gets more weight in the indicator if it's more related to the real economy, in this case industrial production. So if money markets or banking intermediaries are more related empirically with industrial production, they get a higher weight in this indicator. So this indicator is then done. It's normalized between 0 and 1. So basically, the 1 is an upper bound. So very close to 1 is basically the maximum degree of systemic instability, and very close to 0 is basically almost no systemic instability. So very easy to read. And So what you see, and I would argue this is it's still market-based indicator, but it's truly a systemic indicator because it's widespread, all the components of financial system. It is takes dependence into account across the different components, and it has a link to the real economy. Remember the vertical perspective on systemic risk. So now, okay, that's just an indicator. It's a contemporaneous indicator. It's an empiricistic measure. It's inductive. It's not. There's some theory behind, but there's limited theory behind. It comes from the empirical side, not from the theoretical side. What can we do with such a thing? Let me give you one example to illustrate why macroprudential research, systemic risk research for central banks may be very important. Remember 2007, 2008, and I don't have the time to show you all the charts. I could show you all the charts, but I have to tell you in words to be faster. Most policy institutions that forecast the respective economy, US economy, Euro area economy, country economies, actually made very large forecast errors. So they tried to predict growth and inflation, and they made unprecedentedly large prediction errors, forecast errors in their macroeconomic forecasts for their economy they're in charge of. Now, so the question is, of course, and when people then commented macroeconomics has failed, the current paradigm is useless, it neglected what exactly was precisely needed in a crisis, is to link financial crisis to the macroeconomy, and actually these models didn't have actually any financial sector, let alone financial instability. So here's an empirical attempt to go about this problem. It's a model that we have done with 3 other people from ECB and the Federal Reserve Board, and it does the following. Let's take a standard empirical macroeconomic model, a vector autoregression model. So everything can depend on everything subject to some identifying assumptions. Let's add to this, we take the standard variables. Output growth, inflation, short-term interest rates, maybe a bit special credit growth, also not very considered before the crisis. But then we add as a 5th variable the KISS into this indicator that you have just seen, as a variable that we have a gauge of the degree of systemic instability in the macroeconomy at a given point in time. But in addition to that, remembering the huge forecast errors that were made, we wanted the model to be potentially highly nonlinear at a macroeconomic level, at the aggregate level. So we do enter into this Bayesian estimated vector autoregression model Markov switching, regime changes. And we enter it in two ways. First, we allow the area variances of the VER equations to jump. Actually, the model finds the data dictate that there are 3 regimes for the variances. Say, let's call it low, medium, and high variances. These are the shocks that hit the economy. So they can be low, medium, high. Obviously, in a huge financial crisis, high shocks. But the issue is it only the shocks, or is there more something structural? And actually, key point of this paper is there's something really structural about systemic financial crisis. We also switch the parameters of the model. All the parameters that link the variables, the 5 variables to each other are allowed to switch regime, change size, as dictated by the data. And the variances and the parameters, that means the shocks and the structure of the economy that determines how the shocks are transmitted through the economy, can change independently. You can distinguish the two. We find 2 parameter regimes, say, let's call them for simplicity high and low. Actually, high is characterized by particularly large transmission to the real economy. Low is characterized by limited transmission of financial shocks to the real economy. So if you take 2 parameter regimes, 3 variance regimes, you get 6 regimes. And what I want to highlight here out of these 6 regimes is one is the regime 6, where both parameters are high and variances and shocks are high. Is a 6th regime, which we call systemic fragility. It is the regime, as I said, the shocks are very large that hit the economy, and the transmission to the macroeconomy is particularly large, as determined by the parameters. If there's a financial shock, the GDP growth reacts particularly strongly. And what's interesting is that these regime 6 emerges precisely in the model if you calculate the usual Markov state probabilities at the height of the most systemic financial instability, as indicated by the KISS. This regime change to 6 happens basically mainly here in those quarters and for a short period around September 11, but it's very short-lived. It goes very, very fast. Then there are other regimes that are medium range, quote-unquote dangerous, but this regime 6 really sticks out as very special in that it has high transmission to the real economy and large shocks. Now, what are the implications of that? Let's look at impulse response functions of a shock in the KISS. Systemic instability goes up. What's the reaction of output growth? So how large is the effect on the macroeconomy in terms of growth? I have painted put into this chart 3 impulse response functions of such a shock and transmission. The dashed blue line is under tranquility. Let's say regime 1.1 or regime 1.2, say low parameters, low or medium variances, for example. You see that a financial shock as an increase in the composite indicator of systemic stress has almost no impact on the macroeconomy in a state of tranquility. Now let's go to the regime 6, the one that I described to you before. That is the impulse response function when there is regime 6 of a KISS shock on growth. So you see that the recession that follows is massively larger than of the same kind of shock is massively larger in the regime of systemic fragility as compared to the regime of tranquility. Now, what would happen if you have not if you don't use in your forecasting or general scenario analysis such nonlinear tools? Well, let's assume the parameters are constant, they can't switch. Then the impulse response function would obviously look like in between the two, this dotted black line. So if you ignore the structural instability that happens in the economy in a systemic financial crisis, you would make massive forecast errors by neglecting these nonlinear adjustments in some very extreme states of the world.
Can I ask a question here?
Sure.
I mean, you've got a 5-dimensional system, which I guess you're treating in discrete time. So you've got a sort of, the coefficient matrix is 5 by 5. There's quite a lot of parameters to determine. And now you're going to have 6 different regimes. How do you choose the parameter values for each of those 6 regimes?
So they're estimated with these Bayesian methods. That's the state of the art in macroeconomics now. So it's not the classical statistics, it's with these Bayesian methods. There is indeed, these are small scale models. Still, they have, if you multiply 5 times, lots of parameters to estimate. And it's Euro area, we have limited observations. It's discrete time, so we have limited observations. Clearly, it's a problem. The precision of estimation, the stability of estimation is an issue here, no doubt without it. So I would not deny this. There's a problem of dimension. And now we could not claim that such estimations are super precise. I think at this point, we make a qualitative point. We want to illustrate a point that is really something that was missing, in this case in macroeconomics before the crisis. And what we can also do, just 1 second, so is what I didn't show you here is we can do real-time state probabilities. So we can track the likelihoods in which regime you are. Are you in regime 6? And that gives you an input into policy discussions. Are we in an emergency? Are we in a systemic fragility situation? Do we have to be super cautious and forward-looking in policy? Because the model gives you kind of a nowcasting of this, when you are in a state of systemic fragility. Now, but again, when we found like in a mini exercise of type 1, type 2 errors, a very simple one, that it performed reasonably well if you do it real time. Yeah, it performed reasonably well. But again, I think this is, at this point, it's a very difficult model with a problem of dimensionality, which is useful, particularly for scenarios, maybe for nowcasting, but I wouldn't claim that we are super precise in predicting the effect of the next crisis, if you want. Okay, this type of thing. That's fair enough. Actually, it's not about predicting crisis. It's only about to assess the real impact of crisis. It doesn't have embedded in its features that I would like to have in the future to also look what causes the buildup of the imbalances of the crisis. That's not part of that model. So let's move on. The KISS indicator was an output of the Macroprudential Research Network, and this vector autoregression Bayesian VER Markov switching model was an output of the MARS network, the Macroprudential Research Network. I show you quickly what that was. I led it over the last 3.5 years. Martin Summer, who is sitting here, was contributing to it, for example, from the Austrian National Central Bank. Maybe other people in the room were also involved. It had the mandate to develop core conceptual frameworks, models and tools that provide research support to improve macroprudential supervision in the EU. We divided the work in 3 work streams. The first was called Macro-Financial Models Linking Financial Stability and the Performance of the Economy. And the VR model, the Markov switching VR model, is an output of this work stream. This is particularly geared towards this lacuna I was mentioning before, that for reasons that are now very difficult to understand, in the decades before the crisis, macroeconomics had become financeless. There was no reasonable financial sector any longer, and this really tried to make a big contribution for our own purpose to rectify this, to have macroeconomics models that have a particularly distinct role for financial sector and financial instability. Second work stream was early warning system and systemic risk indicators, and the KISS that I just showed you was an output of this second work stream, a contemporaneous indicator. I will show you later an early warning tool, just as one example of what they did. And third is assessing contagion risk, was the third work stream. And again, I will show you one example of a simple model that we have developed in this context, drawing on our payment system data to assess contagion risk in the euro area. Now, output, the MARS has produced roughly 160 odd papers. Now, of course, we did not stimulate all of them, but still, it was a massive collective effort. Divided by these numbers per work stream. About half of them are now out as ECB working papers. You can find them on the ECB website. Now more and more coming out in journals, some in top economics journals by now, like Journal of Financial Economics, for example. We put particularly emphasis not on the individual research papers as such, because they're often very specialized. We ran a number of collective cross-country model projects, where we put the resources of several central banks of the EU together and worked on a particular output. And I will show you an example of this later. And when we had 3 large conferences, some of you may have attended them, and if you want to know all, I can only talk about very little about MARS. I want to give the general overview. The MARS only provides a few examples to illustrate some points. You can find a comprehensive report on our website in a press release. It was published in June this year. The MARS concluded its work in June this year. So let's go to the little economic framework. If there are no other questions at this stage, let me quickly ask. So, I mean, I have developed this over the last 15, 20 years. It's a heuristic way of putting a lot of empirical and theoretical research in a condensed way and in a way that communicates also with people that have to make the bridge between research and policy. Where does systemic risk come from? What are the ultimate sources of systemic risk? So if you go through all the theories that we have, published or unpublished, you will find that there is not 1 or 2 classical economic market imperfections that cause systemic risk. You have models with very different so-called market imperfections, market failures, that actually exhibit forms of systemic risk. And I've listed here in the left-hand arrows some of the most important ones. For example, incomplete markets. As Buiter correctly pointed out in his blog a couple of years ago, if you want to have phenomena as crucial for financial instability as bank default or market illiquidity, you have to work with incomplete markets. If you have complete markets, these concepts are not relevant. Second, asymmetric and imperfect information. A lot of new contagion work has to do, for example, with adverse selection phenomena coming from asymmetric information. Related to that, but not identical, externalities, economic externalities, play a big role in contagion analysis, for example. Again, related to that, the public good character of financial instability, of financial stability. Financial stability is a classical public good in all respects. It's non-rival and non-excludable. So it's really a public good. It would be under-provided if the market was in charge of it, subject to these imperfections. And then there's also the phenomenon of multiple equilibria that we know from work like Diamond-Dybvig, but also extensions of it to the systemic dimension. So there's multiple frictions or imperfections that tend to be seen as sources of systemic risk. Often you need them actually together in order to have severe systemic financial crisis in a model. But that alone, these imperfections you have in any economic model, with financial crisis or without financial crisis, nothing special about them. So why is the financial sector particularly prone to systemic risk? Now, I came up after looking at everything that I knew, practically and in theory, in research, with these three special features of a financial system that makes it particularly vulnerable to systemic risk. One, the information intensity of financial contracts. Many financial contracts are particularly forward-looking, with undetermined future cash flows, more than other economic transactions, not like all, but many other. Or they are particularly complex, the instruments that are sold on the wholesale market, but also sometimes in the retail market, in terms of information processing. So that could make it particularly vulnerable, the financial system, to problems of asymmetric information, imperfect information. Second, or the multiplicity of equilibria if you have relatively rational expectations about the infinite future, for example. Second, balance sheet structures of intermediaries. Financial intermediaries are characterized by high leverage compared to other corporations, and balance sheet mismatch, other balance sheets mismatches like liquidity mismatch, maturity transformation, currency mismatch, and other things. So they are so pronounced that actually the correction of these balance sheet imbalances in a stress situation can lead to large fluctuations. That's the second special feature of the financial sector relative to other economic sectors, which makes it prone to systemic risk in the presence of multiple financial frictions. And the third is the high degree of connectedness, not only within the financial sector, for example in the interbank market, in derivatives market, and so on, but also between the financial sector and the real economy. Basically every real sector, every sector in the economy depends on the financial sector, either as a borrower or as a saver. And therefore, the connectedness with the real economy is very high.
If I say that there's a really important fourth special factor, which is greed.
Greed.
I mean, it's very, very difficult to think about the financial system purely in these mathematical terms without recognizing that the financial incentives on some players to game the system are simply astronomical at a scale that no other system, including the criminal law, has anything like the level of financial incentives of people to play it. And it's really important that we recognize that, otherwise we're just not living in the real world that we have to deal with.
I can go along with what you're saying, staying a bit more unemotional, but let me add two things to what you're saying. First, I know two words and actually use them both. One is greed, the other is risk-taking incentives, right? So we can use them interchangeably, and we know that some of these imperfections actually lead to risk-taking incentives. Okay, for example, certain forms of asymmetric information. I may actually show you some examples later. So that framework can embed greed/risk-taking incentives at an aggregate level, at an overall level. You could embed it in this, but it doesn't go down so granular to the problem you're describing. Second is, I can think of mathematical theories of greed, definitely of risk-taking. I can make it very simple. Standard economics assumes that every household optimizes his or her own utility. Let me introduce in my utility function a term that depends negatively on the wealth of my neighbor, and I have greed. Okay, so I can actually mathematically describe it. Now I'm a middle-of-the-road guy. I like to use mathematics where it's good and where actually it brings value added, but for me, not everything must be in mathematics. In practical situations, I sometimes need to go beyond that. But the mathematicians are very good. They can push the frontiers. They sometimes come up with things you think they can't do, and then they come up with ideas how they can do it. But I think we should look at both qualitative and quantitative things. Now, the combination of these imperfections and these special features make the source of systemic risk. So it was something highly complex. The combination of these two, if you look at the models, lead to powerful feedback effects across different agents in the economy, to amplification, nonlinearities, and regime changes like the ones I just showed. So that's like 20 years of theory in one slide, I would argue, so if you want. Now, where do we go from there? So we need to be a bit, decompose the problem of systemic risk. So I came up with this simple heuristic. I called it the systemic risk cube. We published it in our financial stability review. But I will not go through every component of the systemic risk group, but I want to tell you that basically it's based on the idea that there are three main forms of systemic risk. So this framework starts from the assumption that one important starting point for understanding systemic risk is to understand what makes a financial sector problem instability widespread. Remember my definition. So and that's where this started here. What makes a financial instability instance widespread in the financial system in the first place, and then potentially to the real economy? Well, there are three ways that can happen. And they are contagion, the endogenous buildup and unraveling of widespread imbalances, and aggregate shocks. Let me start with the simple stuff that every macroeconomist, for example, understands. Aggregate shocks. Of course, for any type of capital levels, you can always have an economic disaster outside of the financial sector that's so bad that most banks in the system would go bankrupt. Okay, it's definitely a source of systemic risk. It's exogenous in a strict theoretical sense, and so I call it aggregate shocks, like it's in macroeconomics usually said, even though we only introduce now financial instability in it. Let's go to something that was highly researched already long before the crisis: contagion. Contagion is if an idiosyncratic, a supposedly idiosyncratic problem of one agent, through some imperfections, transmits to other agents or other parts of the economy, other than if it hadn't been the case, if there weren't those imperfections. So strictly speaking, it should not have been transmitted to the others, but due to some imperfections, actually, it propagates to the rest of the economy, to other agents. That's a pure form of contagion. And it's a very relevant form of systemic risk in the financial sector, for example. The third is actually the one that may have been overlooked before the present crisis, the recent crisis. I call it the endogenous buildup and unraveling of widespread imbalances, or the Minsky-Kindleberger type of systemic risk. It's different from contagion. I come back to that. The endogenous buildup and unraveling of imbalances is that in financial sectors, due to the incentives that we just addressed actually, there can be situations where many agents, let's say banks, can invest in similar assets. For example, in a search for yield episode. There are certain imperfections that give incentives for risk-taking and incentives for herding, for example, externalities. Also related to compensation practices, zum Beispiel. They can give, for example, they can give incentives for herding behavior. And that means over years, the same assets can spread independently across the balance sheets of many intermediaries in the system. But as long as the bubble, quote-unquote credit bubble, say, is building up, it's profitable for everybody that invests in this activity, that engages in this activity. Only when the market starts to lose trust in the valuations of these instruments, and it was particularly difficult in the context of structured credit, for example, trading, where the instruments were particularly opaque, there was a lot of trust in those instruments. It was a searcher for yield machine, but only at a very late stage when there were some signs of some hedge funds getting into difficulties, mortgage markets in the US going down, investors started to question, hey, what is in those assets? And a repricing of risk set in. And actually, many banks at the same time were in trouble because the valuations of a wide range of assets went down that were of similar type of assets on their balance sheets. And therefore, there was a simultaneous systemic event on the balance sheets of many banks at the same time. That's not the same thing like a contagion event, where an idiosyncratic problem, the buildup of an imbalance is the buildup of a systematic problem, not an idiosyncratic problem. So these are the three forms of systemic risk, and I tend to structure my thinking of systemic risk around those three forms. And you have them summarized in this cube. For example, just give you one example. Let's take contagion. This cube distinguishes triggers, origin of the problem, and impact on the economy. And if you take contagion, it's this orange front column of the cube. you see that the trigger of a contagion event can be exogenous or endogenous, can be fraud in a bank that is highly interconnected, that would be exogenous, can be endogenous, like many people have the same assets, but then there's a loss of trust and there's asymmetric information, and therefore also banks that don't hold these bad assets are actually affected by an unraveling of an imbalance, but in the form of contagion, because they don't have these assets. Simply the asymmetric information makes people to be very conservative and also withdraw, for example, their wholesale funding from them. So it can be endogenous. The origin can be only idiosyncratic. That's the very definition of contagion, that the origin must be something that's normally contained, but for some imperfections becomes widespread. And the impact is is sequential. So the notion of contagion is something that, at least in theory terms, is sequential. Of course, with forward-looking expectations, it can actually empirically materialize simultaneously, but it's sequential. One problem emerges, and that causes the next problem, and so on. Just as one illustration of this systemic risk cube. So, 3 forms of systemic risk: contagion, the unraveling of widespread imbalances that have built up over time, and aggregate shocks. So I will now give you 3 research examples from the Mars network where in one way or the other we addressed those. I could give you many other examples, some more rocket science and deep theory, others more little analytical tools that you can use in practice. So here I start with something very involved but designed for practical use. So we go first to the unraveling of imbalances. So if you want to identify systemic risk as caused by and endogenous buildup of a widespread imbalance, you can use the classical tool for doing this is so-called early warning models. And now in many respects this is a very sophisticated early warning tool. It's there to identify vulnerable banking systems. I try to explain it to you in 3 minutes or something. I hope I manage. I think we have lots of mathematical minds in the room, so I guess you look at this and you know already what's in there. How does that work? It's actually a methodology from machine learning used in computer science and in artificial intelligence. The authors here, my colleagues from our financial stability department in this case, have started with like 30, 35 odd variables that whoever you ask in the community what is a useful early warning indicator, which variable they should consider as a candidate. Then they randomly generate 1,000 trees from these variables. And I will, bear with me, show you how a tree grows in a second. 1,000 trees, which characterizes from the variable that predicts instability the best at the top to variables that add additional explanatory power, predictive power, if you combine it with the best performing variable. That's a tree. And they do it randomly for 1,000 trees, randomly. And they do that looking then at the trees and evaluating the performance for predicting systemic banking crisis 1 to 5 years ahead. So for each of the variables, of these 30 variables, scattered over these 1,000 random trees. Then they look for each variable, for each time period, each variable, different thresholds of signals of a problem, and countries. This is I think it's EU actually, EU for a certain number of years, like many decades back, of systemic banking crisis. For each of these variables, they look what is the within the respective random trees the predictive power a variable has for signaling a high likelihood of a systemic banking crisis in the next 1 to 5 years if that variable has exceeded a certain threshold. From that, they get a ranking of these 30 to 35 variables, which are the best predictors of financial crisis. They pick the top 15, could be 12, could be 18, I don't know, they do 15. And they grow one tree. And that's the tree again, and that's the tree you see here. They take these 15 variables, take the one that predicts best for an optimized threshold, 1 to 5 years ahead, a banking crisis. It turns out to, in this run here, for this data, the bank credit to GDP ratio. Then they add other of these 15 variables depending on which one diminishes the prediction error. Which one is the next best variable that actually would, of course, the best one is the bank credit to GDP, but of course there's still type 1 and type 2 errors. Like, it may predict in a certain time in a certain country with a high likelihood, but there's still another likelihood that actually the crisis that was signaled doesn't emerge, or a crisis emerged and this particular indicator at that time in that country has not given a signal. So they add then other variables. This is the next best. If the bank credit to GDP is over 93, this ratio, then this indicator signals a probability of a crisis. The next best is the credit to GDP gap, which is the same thing relative to some average, simply said, over time, like the credit to GDP gap. Then again, it can distinguish above a certain threshold. It signals a crisis with a certain probability below a low crisis. For example, if you have bank credit to GDP above 93, but then bank credit to GDP gap is below minus 0.8, you have actually a crisis probability of only 0.01, very low. But if you go on this branch of the tree, you can go add other variables, and actually you get, for example, at the end, a rather high probability of a financial crisis, banking crisis, 1 to 5 years ahead, if you go down the whole branch of the tree. So now, you have this quote-unquote optimal tree, and then you go to a macroprudential policy authority. You take a certain time period, a certain set of countries, and you can find for each country and each time where the country is located. And then you can say, I get a signal of a low crisis probability for this country, but for another country I may get a very high crisis probability, here or here, for example. So this is a very sophisticated data mining exercise that can be used for early warning methods that to identify vulnerable banking systems that are particularly vulnerable to systemic crisis in the future. And actually my colleagues are actually making this operational as a tool in the context of the ECB's macroprudential monitoring.
So Chris asked a question about this 5 by 5 matrix earlier. So here you have a much higher dimensional model because the number of configurations of the trees you can build is just combinatorially exposed. So isn't there a big risk of overfitting the past data? And is there any notion of out-of-sample testing of this indicator to see what you would have predicted? For example, if you stopped the data set in 2007?
Yeah. I would call, this is, I like to show this example because it's not economics. So it's other sciences that have done that, and I think we need in society to do that. So now, translating this type of approach into my words, I would say it's a non-parametric approach. So there is no problem of number of observations to number of parameters. So there's a different problem, it's theoryless, it's black box. That's more the problem. So there is not a problem of, I think the notion of overfitting, there may be, the problem is maybe the rareness of systemic banking crisis. You have
a case where this kind of approach is used, and very successfully so, is when you use the help file in any software, like the help file of Microsoft Word. That's what it does. It's some trees, decision trees, and millions or hundreds of millions of users contribute to this data. And when you have a problem, it says, should I notify Microsoft what happens? Yes, that goes there. So, and there, the idea is that it works because the users will encounter similar problems all the time. It's the same software. You're not going to do, something. It's repeated. So the data from other users is actually useful to feed into this tree. But here you have a more difficult problem because the data is much more scarce.
That's true. There are crises, but this is a problem with any with any forecasting or early warning in financial crisis, because the real ones you're interested in, the really bad ones, are happening every 30 to 50 years, and our data are not long enough. This is a problem with any I think it's the big curse of early warning, one of the two big curses of early warnings of financial crisis. And I don't think you can, I have worked, when I started systemic risk, with you may know, with extreme value analysis, multivariate extreme value analysis, which is a method that actually distinctly tries to get a handle on the rarity of extreme outcomes, in this case the dependence of extreme outcomes. But also there you can attack it on certain dimensions. So you will never get really out of this curse of rareness of systemic crisis or really extreme events, and particularly highly dependent extreme events. So that's something that is hard to get out. Extreme value theory handles it by entering some very mild distributional assumptions, like limiting it down to a certain limited classes of distributions, and therefore and then imposing very limited parametric elements. But again, you really don't get around that. It's in one way or the other. I found this method really, the strength is it uses a lot of information. It throws away very little information.
In this context, let me raise the following observation. First, what makes this really, really difficult, because you do expand and get a lot of crises if you look at individual European countries over many, many years. The problem is, of course, that the system keeps changing on us. So the standards for how we do the accounting changes, new financial instruments occur, the whole industry restructures in certain ways. So it would be very important to keep updating the tree very, very frequently. So that was one observation.
Which
there's
may
a
have
big trade-off between the
negative
number of
events.
observations and how long you think there's any predictive power. The second thing is it's non-parametric, and I don't understand machine learning all that well. There's some very, very interesting work by Serena Ng where she tries to take econometric principles to the most successful machine learning tools that have been found. And I'm not an expert in that, but it was very fascinating to see she established some connections between certain deeper principles in inference and what these machines actually, I wouldn't say trial and error, they cleverly, these algorithms have come up with. So there is hope that we can get more of an understanding, both from a statistical and a machine learning context, what might be going on. And maybe that will help when we take into account that the things are changing on us underneath, because I'm very uncomfortable with the instability
one-to-one application
of the system that you're looking at.
Okay.
So we need to understand it just a little deeper.
So first, thanks for the reference. I will try and give it to my colleagues who are working at Columbia. Okay. Actually, you touch on the second curse of early warnings, which is that actually economics is very negative about early warnings. The economics profession has basically denied, after the Asian financial crisis, to work on early warnings, because they say you never predict. You always fit in sample the past crisis and you never predict well the next crisis because of inter alia, the structural change you are mentioning. And I fully buy this. The problem is, if you have a policy authority who has to make assessments, you have to do something. You cannot look at you must look at the imbalances and tell people, policymakers, this looks red, this looks orange, this looks green. It's better to have some quantitative things rather than others. But again, you will not get around the structural instability of the economic system as such. You can maybe improve entering some econometrics into this fully non-parametric approach, and I'm interested to see that. But if you update the tree more frequently, obviously you use less, in some way, less data. You make your prediction with less data, and that may be becoming more less good in predicting, because you have very wide dispersion, for example, around the predictions. There's no free lunch, but I mean, economists don't do this, but I found it really useful way to think about the problem. I do still have. I have to hurry. It is actually no. Actually, we need to close pretty soon, because we need your discussion. So I should really. I don't know. You tell me. Okay. So this is now we go now from the widespread, from the endogenous buildup and unraveling of imbalances, a tool to identify vulnerable banking systems, an early warning tool, to contagion tool. Now this must be very familiar to lots of you. It's like a counterfactual simulation. Actually, So, and actually it is a simple way of putting in a counterfactual simulation contagion model what you have done at the Bank of England, the marginal contagion in a primitive way, how a failure of one bank actually affects other banks. Now, the peculiarity here is that we made a joint cross-country project where we put our payment system data together. Yeah, there's a mechanism called the Verfine mechanism with which you can back out the interbank exposures from large value payment systems that we did. A huge project with our payment system department in the context of the Mars, gave 15 researchers access to this highly confidential transaction by transaction data. And then this was one project that Banca d'Italia colleagues, the colleagues mentioned down here, actually conducted. And they tried to emulate this marginal contagion idea in counterfactual simulations by having a simple way of representing market transmission mechanisms in contagion. And it works the following way. You take the interbank exposures as derived from a Verfine algorithm between the different banks. You let one bank fail, and the dot in this chart is a bank that's assumed to fail, anonymized. And then you look how this is transmitted into other banks, but to other banks in terms of losses. But contrary to the standard literature, which looks only at default cascades, like failures after the first failure, which is a very high threshold and usually finds very little contagion risk, here there is an emulation of market transmission by taking into account the balance sheet strengths of the bank. And then the measure is not whether other defaults happen of systemic instability. The measure is how much of the equity is erased of all the other banks, other than the ones that defaults at the start, in the overall system of target connected banks. And this depth rank here on the vertical axis is basically in percentage of total equity of all the banks connected to target, the share that's erased through this methodology if one of these dots fails. And how is that done? Basically, it takes into account not only the interbank exposures that are lost if I fail and I owe you money and I fail, you don't get the money, you have a capital loss. It also is adjusted, this exposure, through relative losses, like how big was my loss relative to my capital, am I in really bad shape or am I in better shape, and how well was my capitalization relative to other banks. Am I very well capitalized or am I badly capitalized, to start with, relative to other banks, not relative to my losses, relative to other banks. So then these Verfine exposures are adjusted. And then we run counterfactual simulations where we let every bank fail once connected to target. And you have here again this measure of systemic effect of an individual failure. They call it depth rank. It goes back to a methodology from Battistong and others. And on the right hand side you have a measure of size. Just to illustrate what you see, we took a relevant period here, December 2008, and did these counterfactual, the authors, these counterfactual simulations 2 months after Lehman. Is the time where we really wanted to know what is the interbank contagion risk in the banking system, for example in the euro area in this case. And you see 2 things or 3 things. First of all, for most sizes, banks, according to this measure, are not systemic. But for the very largest sizes, they become very quickly very systemic. So there's a very big non-linearity in size, the effect of size on systemic risk. Second, this is not, there's quite a bit of dispersion. For example, this bank here is only a medium-sized bank. Notice this is not in log terms. Is a medium-sized bank and still has a very large impact. So for example, clearing banks that have a big role in the payment system, clearing system may be medium-sized, but may have very big exposures and therefore may be a source of systemic risks every now and then. Just one illustration of how we have developed an infrastructure to simulate contagion risk in the interbank system in the euro area. And basically we can do this now every week. You know, if another Lehman happens, we can within a few days tell the policymakers, if you use this approach, this is how bad, if you let it fail or not let it fail, this type of bank, the impact on the interbank system would be. So extremely useful. Lots of shortcomings I cannot talk about, but one useful input to assess contagion risk, the second form of systemic risk. I'm really worried about time. I had a third example about aggregate shocks. I think I should jump over it because it's noon. Is this clock correct? This clock? Sorry? So I have no time left. So I should. I think I will need a lot of time. This is a model to explain the aggregate shocks and what bank capital can do. I mean, it's kind of takes some time.
It's really interesting. Give it more time.
Maybe you could take some time to explain.
Okay, okay. Sorry, it's very hard to, this massive amount of work we've done in the Mars to capture it in half an hour or something like that. And, you know, combine it with the kind of the overall view on what you should know as a starting point about systemic risk and where does what belong and, you know, what talks to which problem. Okay, so now we talk about aggregate shocks, third form of systemic risk. But I want to go 2 steps in one. I not only want to look at identifying systemic risk from aggregate shocks. Actually, here I'm interested in what can you do against it from a policy perspective. So this is a macroeconomic model that is designed to characterize financial instability, and I will tell you in a second how it does that. But it is particularly designed to capture the costs and benefits of regulation in terms of reduction of systemic risk, in terms of benefits. And reduction of systemic risk in this model means more growth, more consumption growth for individuals in the model. So there's a genuine benefit. Versus the costs of financial regulation from a systemic angle, from a macroprudential angle, which is here that if you impose a regulation, it has also effects on other things than the negative imperfections, the part of credit or lending that is related to imperfections. So how does it work? So it's a macroeconomic model. Actually, it's dynamic, stochastic, and general equilibrium. It has it shares the pre-crisis paradigmatic, like the deep assumptions that macroeconomists like to make. But it has little in common with the pre-crisis DSGE models. In particular, what it does is it embeds a formulation of default for all 3 sectors in the economy, for banks, for households, and the firms. The banks can lend to firms and to households for mortgage purposes, firms for investment purposes, and all these 3 agents are allowed to default in this framework. And a default creates cost. Default of a bank means this credit for the moment is away, can't be given to a household or to a firm. That firm can't consume, that firm can't invest, creating growth. The household can't consume, creating welfare, and so on. Also, default of households means less demand for firms. They can sell less goods. They invest less. Growth diminishes. Everybody loses. So. It's really a model where, in the macroeconomic model, where there's a banking system, heterogeneous banks, households, and firms, and all these 3 agents can default and cause real costs. Now, the imperfection here in this model is that the banks have incentives for excessive risk-taking, say some public guarantees or other things makes them to take excessive risk on their asset sides, and therefore imbalances build up. There's too much credit. There's some credit given to the economy that's inefficient. And then there can be aggregate shocks that are through capital and funding costs amplified in this model. In this paper, which is the prototype of this so-called 3D model, the 3D model is again a joint cross-country project in the Mars where we developed this model with 5 central banks, a consultant, and the ECB. We particularly focus on the steady-state capital requirements against those shocks and at countercyclical capital buffers, although I will not show you anything about that. Higher capital requirements, which is the regulatory tool that is used in this model to see how it performs against aggregate shocks, have 2 effects in this model. First, they correct the risk-taking incentives here, these imbalances that can build up. So you're obliged to hold higher capital than you would otherwise do. So you have to diminish your lending, and there's leaning against the excessive risk-taking in that regard, the capital requirements. But however, they also crowd out some other lending. Like the banks hold the higher capital, but the capital requirements are not geared towards one or the other form of risk, of lending or borrowing. And therefore, it also has some cost in terms that also some borrowers get less credit from the firm, even though the credit to them is not excessive lending as a consequence of this inefficiency in this economy. So a trade-off emerges, and if you calibrate the model to the euro area and you make a welfare curve of this type where you have the capital ratio, it's something similar to tier 1 capital, in percent, so 8%, 9%, 10%, 11%, and you plot it in terms of the steady state consumption growth here, you can see if you increase capital from a low level, you first, the beneficial effects overwhelm the negative effects, and then up to, beyond a certain hump, a certain maximum, actually the negative effects on credit supply are more important than the positive effects. Now, in this calibration, the maximum is found as 10.5 tier 1 capital, tier 1 capital, but we do not take these type of numbers literal. Don't come and say ECB criticizes Basel III, we have higher, but I don't think this is a prototype of a model. We don't really think about very granular numbers here. We make, again, a more qualitative point. So this is the trade-off that this model. So, but think about one thing, how to see what's the importance of this. You saw my definition of systemic risk. It is aggregate. You have to think aggregate. Systemic risk means also, like, if you I regulate now against it, is really the effects, are they beneficial for everybody, like in terms of general welfare terms. So, and then think about the MAG, the Bank of International Settlements Macroprudential Assessment Group, who did assess Basel III along those lines, looking at the costs of the regulation, looking at the benefits of the regulation, and they found certain things. And the MAG did not have any tool that it could use where the cost and benefits were integrated in one model. They had to, calculate the cost from one set of models, empirical and theory, and the benefits from another. So they were not strictly comparable in that sense. So the benefit of such a tool here, and we have developed this as a tool which we want to use in policy assessments, future regulatory policy assessments, one quantitative tool, is that it actually in one framework can compare the costs and the benefits. And this is something, a very important research field, I think, where we have to invest, that we can really do this in an aggregate framework to consider the costs and the benefits of regulation. And this is why I want to show this. Now, quickly, just to give you an idea about the dynamics and the effects of aggregate shocks and what's the importance of these defaults. Let's just look at the left-hand side, this impulse response function to a aggregate shock in this model in terms of growth, just in terms of growth. So the shock assumed here is a persistent decline in home prices and firm valuations. So it's an aggregate financial shock on both real sectors. So if you take a low capital, in terms of this calibration, low capital requirement of 8%, this is the impulse response. So you have this recession that's caused by this shock. It amplifies through the model, and then the economy recovers. If you had the quote-unquote optimal capital requirement of 10.5, you would significantly diminish the extent of the recession. So that's the value of a capital requirement from a dynamic perspective. The curve I showed before was a steady state perspective. Now, in order to see what's the importance of default in this, in a transmission of an aggregate shock, let's switch off bank defaults. Let's just assume counterfactually that they're not there. If you switch off bank defaults, the effect of switching off bank defaults is about the same size in this calibration as going from 8% capital to 10.5% capital, from a low capital requirement to the quote-unquote optimal capital requirement. So the risk of bank defaults for the real effects of an aggregate financial shock is really important according to the message of this model. And capital is to some extent effective in actually diminishing it, and we can think about it in terms of costs and benefits and try to fine-tune its level. Okay, I have 2 slides on the policy instruments, like an overview, contagion, imbalances, and aggregate shocks. What are all the policy instruments? I think I can't do this to you now. So I jump to the conclusions, okay? If we come back in the discussion to the policy, I'm jumping back. Okay, so 1 slide conclusions. What's the state of macroprudential policy and research? Well, in policy, it was really something that was almost not developed before the crisis, and now everybody agrees that it has to be developed. Some steps have been made, for example, in the context of Basel III, but we are really at the start to developing this. And there are many people pessimistic how far we can get into developing the policy side here. I personally think I'm among the people who think we really have to push very hard, and I think that research has an important role to play to give people confidence in actually trying this policy branch out. I could give you examples on the current conjuncture why I think it's important. In terms of research, the research community had already illustrated certain forms of systemic risk very well, like contagion. There was a very active contagion literature 10, 15, 20 years ago, but not other areas. For example, empirical early warnings were completely abandoned after the Asian crisis. People became very pessimistic on working on this. There's hardly any research done in academia. The central banks do them for themselves, or the macroprudential authorities. Or these type of macroeconomic models that actually can really assess costs and benefits of regulation didn't exist at all. So I would argue that we are at the start, but in terms of research, the Mars has made a significant step in some good directions, and I see also in academia a number of directions where things are really improving, where we were not so good in the past. But where would I suggest we need to particularly invest from the angle of a policy authority that has competencies in this area? I've made the shortest list I could come up. I have a much longer list, obviously. What would be my wish list? So here, like, make academia more interested in early warning work and the empirical identification of imbalances. For example, when is the credit growth good and justified by productivity, and when is it a credit bubble? Hugely difficult problem, where people basically didn't touch it any longer. In the rational bubbles literature before the crisis, bubbles were optimal. They were welfare increasing. Okay, just to see the drasticness in which we have to change our thinking. I saw lots of contagion work in this workshop, I think. So here, the focus, I would argue, should be particularly on endogenous market reactions and amplification mechanisms. That would be very important. Fire sales, endogenous reactions of the agents in those economies. Then, very important, I think also, the difference between contagion and the unraveling of imbalances. You can very easily, if you see bank failures or bank imbalances, bank fragilities, you're often not sure, is this now a contagion or is it an imbalance that unravels? And the policy response is entirely different. A contagion event you can contain by just stabilizing the source. An unraveling of an imbalance, you step one, the next fails. You stop another, the next fails. So I think we need to understand, because you see Bear Stearns, it was taken over. Was Bear Stearns the sign of contagion in the system, or of an unraveling of an imbalance that everybody had these credit exposures? Then Lehman failed. Was Lehman a contagion of all the financial problems, Iceland, and a number of other things that happened at the same time? Or was it just the same imbalance, simply it took some time that the unraveling really got hold? So from a theoretical perspective, I think the difference between contagion and the difference and relationships between contagion and the unraveling of imbalances, they are related, they're not independent. Nobody has ever worked on that, as far as I know. I've told the Mars workstream 3, the contagion workstream, please do it. They came up with nothing. It's very difficult, apparently. Integrate financial instability into macroeconomics. If you want true regulatory impact assessments, quantitative regulatory impact assessments, where you have a welfare assessment of a regulatory policy, you need to have financial instability in the macro. And I would argue that this is at least adding a new paradigm to macroeconomics, a huge agenda. And I've shown you two examples, the 3D model and the vector autoregression regime switching model, where we have like 5 more of this type, of different types, where we try to make our own contribution and stimulate the community to come to join in on this, because it's really crucial. Bring macro and stress testing together. Macro stress testing, the classical stress test, which normally the tool how you deal with aggregate shocks. You do a stress test, and then you look, are banks robust to aggregate shocks? There's the practical stress testing is done very different from how macroeconomics is done. So there's very incoherent practical ways of doing it. I think we needed to do it together. So if we do this model of financial instability with macro, we can bring stress testing and macro stress testing and research tools together. Up to now, they're pretty distinct. Same if we do these models, we can do theoretical and empirical analysis of how regulatory policies' welfare effects are at the aggregate level. And if an authority like the single supervisory mechanism at the ECB, which will start in November, 1st of November this year, in a bit less than 2 months from now, They have some macroprudential competencies. They do need really tools to make quantitative impact assessments. It's such a complex problem. It would be much better to also do it with some quantitative tools and not only intuitively and with some more ad hoc number assessments. We should be open, in my view, to non-standard techniques. Economics had too much of a straitjacket. I'm an economist, so I'm blaming myself. We need to look right and left. I've showed you two examples which step a bit outside, particularly one, that step a bit outside economics, and I think we should consider this, including agent-based approaches if necessary. I think I could imagine that if agent-based modeling evolves, I see potential for this being used in this context. And actually, for us as central banks who have to recruit economists, it is actually important that financial instability and the issues that we are capturing here, maybe not in the highly specialized way that the research frontier is, but in some way goes more decisively in the teaching curriculum. Actually, even in the undergraduate level, I think it needs to become part of the picture. Financial instability needs to be part of the picture of undergraduate economics teaching. And an important part, for example, financial instability macro or contagion analysis, an important part in some aspects of PhD programs, because otherwise we have to do what we do now. Basically, we teach people most people don't have any big background, and then they have to learn 1 or 2 years with us. So I think we should integrate this, and I would really welcome if these type of things that are discussed in this workshop and in this whole semester here in Cambridge, and some of the directions that we have here lined out would become part of the regular teaching curriculum. So, and then I'm done. So.
Thank you for this.